Brookfield closed a $9 billion U.S. deal this week, and our next guest says it's just one example of more capital flowing into private real estate. To talk about it, we're joined by Andrew Moffs. He's Senior Vice President and Portfolio Manager at Vision Capital. Thank you for joining us.
Thanks for having me.
Let's tell viewers about this Brookfield deal, first of all, in broad strokes. Which Brookfield is this, first of all?
So this is a Brookfield Asset Management. They are the parent company. They have raised a fund to invest in private real estate through their property division, Brookfield Property Partners, BPY. So BPY is putting in a percentage of the capital alongside limited partners. Those limited partners are some of the greatest institutions globally, sovereign wealth funds, pension funds, all chasing private real estate. In this market, that's something we continue to see, and it only continues with low rates, that sovereigns and pensions are looking for real estate wherever they can get it.
Private real estate is real estate that's not owned in publicly traded structures. Is that a good definition of private real estate?
Exactly, yes.
John?
Yeah, and I think the last time they raised a fund, it was significantly smaller than this. I can't remember the exact number, 4 or 5 billion.
Correct.
And this deal was significantly upsized, I think, from what they originally wanted to do.
Yeah, larger than their original expectations. It's a trend we continue to see. I mean, last year, Blackstone, similarly, one of the largest global asset managers, raised $16 billion US for private real estate. This is $9 billion. And now, of course, that's just the equity that's raised. You add leverage to that, like as you do with any type of real estate investment, you could add you could double that. So $18 billion chasing private real estate.
A lot of pension funds own real estate directly. They actually own office buildings and so on. What's the difference here in pension funds going into a fund like this?
Well, what's different here with Brookfield and the benefit of going with someone like them is that they can diversify and go globally and be opportunistic. When you have such low yields going in with certain assets, I mean, we saw an office building trade here in Toronto at a 3.8% cap rate. And that was just for the building, not even the land underneath. And of course, the cap rate is the yield going in. Pensions are looking for higher yields than that. And so Brookfield has the ability to allocate their capital globally, go into, they've gone into London, for example, Canary Wharf, do value-add assets where they can buy assets, upgrade them, and then sell them back into the market.
What does this mean, if anything, to the world of publicly traded real estate investment trusts, either in the U.S. or here in Canada?
What it does is it provides a floor. Meaning, when you look at this example, say $18 billion needs to go into real estate. It takes a long time buying one-off buildings. Wouldn't be great to buy a platform. And so when you look at the public markets, if you can find those companies that are high quality and basically our portfolio sitting out there, we think we're on the precipice of an M&A environment where these funds are going to go look and say, hey, here are a bunch of quality REITs trading at discounts to net asset value. Why not, in one fell swoop, a lot cheaper to buy one portfolio.
I guess it keeps pressure on cap rates as well, right? You get a lot of buying power coming into the marketplace looking for assets that these REITs already own. Basically.
Yeah, and so the number one thing we do is, yes, we look at cap rates, and I agree with you. The pressure will stay low, especially in this low environment of low rates. But you have to focus on the NOI, because that's the other half of the valuation equation. What's the income being generated from the properties? So we spend a lot of time going sector by sector, geography by geography, trying to figure out which REITs or real estate companies are trading at a discount to their NAV and have that growth in NOI that will be supported by that cap rate.
So you think we may be getting close to another period where publicly traded real estate gets purchased by private buyers? Is that what you're calling for?
Absolutely. Right. Yeah, this environment, to me at least, is very similar to 2006, 2007, where a lot of capital was raised to help finance and acquire real estate. This time around, it's a lot more of a sophisticated buyer, and it's a more permanent buyer. You think about Norway. Think about the Norwegian sovereign wealth fund, the world's largest sovereign. They've decided to get out of fixed income completely. I mean, you have negative rates in Europe, 15 basis points on the German 10-year. So what have they done with their allocation that was previously in fixed income? They're putting it into real estate. That's a big shift, and it doesn't go in and out very quickly.
Okay, thank you very much for joining us.
Thank you.
That was Andrew Moffs. He's Senior Vice President and Portfolio Manager at Vision Capital, talking about the latest trends in private and public real estate.